Hey everyone, welcome back to class 5 of Advanced Accounting. In this class, we're going to continue to talk about how to do consolidation subsequent to the date of acquisition. If you still remember that in last class, we talked about subsequent to the date of acquisition. On the parent's book, parent can choose among 3 of the methods. Those 3 methods are the equity method, the initial value method, and the partial equity method. And in today's class, we are going to talk about 6 scenarios. So depending on which method the parent choose, it can be either of the 3 methods. And depending on whether it is in the year of acquisition. So please pay attention here. In the previous chapter, we talked about how to do consolidation at the date of acquisition. And then here we are talking about subsequent to the date of acquisition, but it is still in the year of acquisition. And then we're also going to talk about how about subsequent to the year of acquisition. So that will almost cover all of the scenarios that we're going to have. And then once we move to the next chapter, we're going to talk about non-controlling interest. So depending on whether it is in the year of acquisition or subsequent to the year of acquisition, and also depending on which of the 3 methods the parent use, we're going to have a 2 by 3, 6 scenarios. And then the consolidation, what we do on the consolidation worksheet will be a little bit different depending on which scenario it is. So if you go on Island, you are going to see a blank handout. On the handout, you are going to see 6 pages. Those are basically 6 consolidation worksheets. And then we're going to go through them in today's class. Each of the situation, they look very similar, but there are also some differences there. And we're going to go through each of the situation and talk about how to do consolidation under each and what are the differences. So first, let's look at after the date of acquisition, depending on the method the parent use. So consolidation process differs a bit. And then let's first look at when the parent used the equity method. There are 5 basic consolidation entries here. Those are the consolidation entries S, A, I, D, and E. And let's look at each of those consolidation entries. First, consolidation entry S. Consolidation entry S stands for stockholders' equity. The purpose, actually, as we already looked at it before. So let me just reiterate it here. The purpose is to eliminate subsidiaries' beginning stockholders' equity account. And the general entry is to debit common stock, additional paid-in capital retain earnings. So whatever stockholders' equity account the subsidiary has at their book value, and to credit the investment account of the parent. That is consolidation entry S. Consolidation entry A stands for allocation. And the purpose is to allocate the allocation made in connection with the excess of subsidiaries' fair value over book value. So this one, we also looked at it before. We debit subsidiaries' asset at the difference between fair and book value. Credit subsidiaries' liabilities at the difference between fair and book value. Debit, if there is any goodwill, we need to debit goodwill account. And we credit the parent's investment account accordingly. Consolidation entry I. So this is a new consolidation entry. I stands for income. So if you still remember in the last chapter, which is consolidation on the date of acquisition. And on that date, we don't need to worry about subsidiaries' income yet because none of those incomes should be consolidated into the consolidated financial statement. But here we're talking about subsequent to the date of acquisition. So that's why we need to introduce consolidation entry I here. I stands for income. The purpose is to remove the subsidiary's income recognized by the parent during the year. So if you still remember that if the parent is using the equity method, it needs to recognize subsidiary's income as its income. So the general entry it is making is to debit investment account, credit equity and subsidiary earnings. And this journal entry is basically to reverse the journal entry that the parent made on its book. So the journal entry is to debit equity in subsidiary earnings credit investment account. And the next one, consolidation entry D. D stands for dividend. So it is to eliminate dividend paid by the subsidiary to the parent because it is an inter-entity transaction. And then the entry is to debit investment account credit dividend declared. So you may wonder, why do we have this journal entry? You may wonder, how is this journal entry where is it coming from? So before the consolidation, do you remember for the dividend, regarding the dividend, what does the parent do and what does the subsidiary do? So if the subsidiary pay out dividend to the parent's journal entry is to probably, suppose it is already paid out in cash. So just to make things easier, we debit cash and credit investment account, right? If the parent is using the equity method. And how about the subsidiary's journal entry? So subsidiary is paying out dividend, so its journal entry should be debit dividend declared credit cash, right? So if you look at those two firms as one firm, actually nothing goes out to the outside party. It's just you are paying dividend to yourself. So cash cancel out. And once we have combined them, you are not really from an outside perspective. If you look at parent and subsidiary as one firm, you are just paying dividend to yourself. So from an outside perspective, nothing happened. So basically, we need to reverse this journal entry. So cash cancel out. To reverse debit dividend declared credit investment account, we basically debit investment account credit dividend declared. So that's how this journal entry comes from. And then the last consolidation is consolidation entry E. E stands for expense. And then it is to record expense resulting from excess acquisition debt fair value allocation. So basically here, if the parent is paying, for example, if the parent is paying more than the book value of the subsidiary to acquire it, if you still remember, we need to allocate this excess payment. And part of this excess payment is due to the difference between fair and book value of subsidiaries' asset or liability, and part may be because of the goodwill. Goodwill is not amortizable. And then, but for the difference between fair and book value, that needs to be amortized. So here we basically, we use consolidation entry E to do this part, to amortize the difference between fair and book value of subsidiaries' assets and liabilities. And the journal entry is to debit either amortization expense or depreciation expense, credit associated assets. So if the difference between fair and book value is coming from a machine, we need to credit machine. If it is coming from some kind of, for example, a copyright, we need to amortize it, we need to credit copyright. And then, so amortization expense and depreciation expense, if the difference between fair and book value, it is associated with a tangible asset, then we will record it as a depreciation expense, versus if it is for intangible, we are going to credit it, we are going to debit it into amortization expense. So that's the difference between these two kinds of expenses. So these are the 5 basic consolidation entries.